I'm Tim Ridley. I'm the Deputy CIO at Vision Super. Today I'd like to take you through briefly the financial year performance, and here we'll be focusing on the balanced growth option. That's where most of our members are invested. In terms of the balanced growth performance, it was a minus 3.8% return. This followed exceptionally strong return in the preceding year, which was over 19%. While the performance last financial year was on the low side, we need to look at performance from a medium-term to long-term perspective. So if we look at our performance on a 3 and a 5-year basis, and we look at that in reference to the Super Rating Survey, which is a standard benchmark used in the industry to evaluate peers, we have top quartile, top 25% performance on a 3 and a 5-year basis. We think that's very pleasing for our members. In terms of the performance over the last financial year, a negative outcome, you might ask why? Well, the key reason is asset prices fell, particularly equities, particularly bond prices. And that reflected rising inflation, much higher inflation than most people expected, pushing up interest rates, and that pushed down asset prices. So you generated quite negative returns coming from equities and also to some extent bonds. One of the key aspects of the equity market performance is it had different performances across different markets. So the US fell sharpest. It was one of the markets that rose very quickly during 2021, so it came off quite quickly in the first half of this calendar year. Our market didn't go up as much in 2021, so it didn't tend to fall as much in the first half of this year. Now, if we look at our options, we have pre-mixed options which have a number of different asset classes. So they have the benefit of diversification. So we have different performance across different asset classes. So that means when we push all the asset classes together in terms of a diversified option, we get a diversification benefit so that the performance is not as negative as equities. So for example, infrastructure and property achieved quite positive returns, and also cash achieved a positive return. So we get a better outcome than equities in isolation. One of the key things when looking at performance after a negative year is not to lose focus on the long term. And this last chart we show here shows the balanced growth performance over the last 20 years versus the cash option. You can see there's a striking difference here in terms of the outcomes of someone investing over the last 20 years in cash versus balanced growth, where you get a much higher return with a longer term focus.